Welcome back to Golden Years Finance, where our goal is simple: helping retirees and future retirees protect their savings, avoid costly mistakes, and make informed financial decisions with confidence. If you spent decades working, saving, and building financial security for retirement, you probably assume that the money sitting in your bank account is entirely under your control. After all, it's your money. You've earned it. You've paid taxes on it, and you've entrusted it to a financial institution for safekeeping. But what if I told you there are banking rules that most Americans never learn about until they accidentally run into one of them? These aren't secret laws. They are not hidden from the public. Yet most people never hear about them because banks rarely explain them in detail when an account is opened. As a result, millions of retirees go through life completely unaware of how certain transactions are monitored, what can trigger additional scrutiny, and which common financial decisions can create unexpected problems for their families. Now, let me be clear from the beginning. This video is not about breaking the law. In fact, the people most often affected by these situations are honest, hard-working Americans who have done everything right. They save responsibly, follow the rules, and simply didn't know how certain parts of the banking system work behind the scenes. Today, we're going to discuss several important banking realities every retiree should understand in 2026. We'll talk about transaction reporting requirements, common mistakes people make when handling cash, account monitoring systems, protections designed for seniors, insurance limits many people never check, and one estate planning decision that can unintentionally put a lifetime of savings at risk. Most importantly, we'll cover a simple solution that could help your family avoid unnecessary complications in the future. Before we begin, if you enjoy practical retirement and personal finance content, please take a moment to subscribe to Golden Years Finance and turn on notifications. Every week, we share information designed to help you protect what you spent a lifetime building. Now let's get started. One of the most misunderstood topics in banking involves large cash transactions. Many Americans have heard rumors about a $10,000 limit. Some believe deposits above that amount automatically trigger an audit. Others assume the government immediately starts investigating anyone who deposits a large amount of cash. The reality is much less dramatic. Under federal banking regulations, financial institutions are generally required to file a report when cash deposits or withdrawals exceed $10,000 during a single business day. This process has existed for decades and is considered routine administrative reporting. What many people don't realize is that the report itself usually isn't a problem. Millions of these reports are filed every year involving completely legitimate transactions. People sell vehicles, receive cash from business activities, settle personal transactions, or move money for perfectly legal reasons. The filing of a report does not automatically mean anyone suspects wrongdoing. However, this is where many retirees make a costly mistake. After learning about the reporting requirement, some individuals decide to divide a larger amount of cash into several smaller deposits. They believe that by staying below the reporting threshold, they are simplifying the process or avoiding attention. Unfortunately, that strategy can create far more concern than depositing the money normally. Financial institutions are trained to identify patterns that appear designed to avoid reporting requirements. Even when funds come from completely legal sources, intentionally breaking transactions into smaller amounts can raise questions that otherwise would never have existed. That's why financial professionals often recommend a straightforward approach. Conduct legitimate transactions normally and maintain records showing where the funds originated. Another area many retirees don't know about involves suspicious activity monitoring. Unlike reporting requirements tied to specific dollar amounts, suspicious activity reviews are based on patterns and behavior. Modern banking systems use sophisticated software that analyzes account activity. These systems look for transactions that appear unusual when compared with a customer's normal financial habits. A retiree who typically withdraws a few $100s each month and suddenly requests several $1,000s in cash may trigger additional review. Not because they've done anything wrong, but because the transaction differs significantly from their established pattern. The same can happen with unexpected deposits, large transfers, or activity that appears inconsistent with information already associated with the account. This is one reason keeping documentation is so important. Whether you're selling property, helping family members, or making a major purchase, having records available can quickly clarify the purpose of a transaction if questions arise. Another development that has become increasingly important involves protections against elder financial exploitation. Across the country, financial scams targeting older Americans continue to grow. Criminals often pressure seniors into transferring funds, purchasing gift cards, wiring money overseas, or withdrawing large amounts of cash. To combat these threats, financial institutions now have greater authority to intervene when they believe a customer may be the victim of financial abuse. In some situations, banks may temporarily delay transactions while reviewing circumstances surrounding a withdrawal or transfer. While these policies are intended to protect seniors, they can occasionally affect legitimate transactions as well. For retirees planning significant withdrawals, communication is often the best solution. Informing your bank ahead of time can help prevent misunderstandings and reduce unnecessary delays. Another issue worth reviewing is deposit insurance coverage. Many Americans assume every dollar in a bank account is fully protected. However, insurance coverage has limits that vary based on ownership structure and account type. Retirees who have accumulated substantial savings should periodically review account balances to ensure funds remain properly protected. A quick review today could prevent unnecessary exposure in the future. Finally, let's discuss one of the most common estate planning mistakes families make. When a spouse passes away or an aging parent needs assistance managing finances, someone often suggests adding a child as a joint owner on a bank account. At first glance, it seems like a simple solution, but joint ownership can create unintended consequences. Once another individual becomes a legal owner of the account, their financial circumstances may affect those funds. Potential creditor claims, lawsuits, divorce proceedings, or other legal matters could create complications that many parents never anticipated. Fortunately, there is often a safer alternative. Many financial institutions offer a payable on death designation, commonly known as a POD account. This allows account owners to maintain complete control during their lifetime while naming beneficiaries who can receive funds directly after death. For many families, this simple designation can reduce complications, avoid delays, and provide a smoother transfer of assets. The larger lesson is simple. Protecting your retirement savings isn't just about owning returns. It's also about understanding the rules that govern your money. The more informed you are, the better equipped you'll be to avoid mistakes, reduce risks, and ensure that your savings continue working for you and your family. And that's exactly why we're here at Golden Years Finance.